Hello, my name is Michael Swanson. I run the website WallStreetWindow.com and I operate a private group for high net worth and institutional investors called Power Investor. I'm doing this video for you to help you prepare for what I think are going to be some critical couple weeks in the financial markets. Now, as you know, in the month of August and early September, the stock market took a very sizable tumble. That tumble made people a little nervous, a little bit worried about the markets, and for good reason. But then, in the month of October, there was a tremendous rally that took place in the stock market, and I saw expert after expert on CNBC proclaim that a double bottom had been put in place in the financial markets, and the stock market was just going to rally for the rest of the year and practically go up forever the way they were talking. But then as the calendar switched to the month of November, the stock market has basically slid every single day into this weekend. And on Friday, after the close, there were some horrible terrorist attacks that took place in France. And in after hours, the hour or two following those attacks, you may not have been paying much attention, but in the futures market, there's a bit of tumble when it came to the market futures in the United States. And if that holds, there's going to be a bit of a gap down this week on Monday. So what's going to happen next? Has the rally we saw in October, is that real? Is the terrorist attack in a gap down on Monday something that's going to crash the market? What can we look to expect here? Well, let me show you exactly what I'm looking at right now. First of all, the stock market is not going to collapse because of terrorism. Look, here's a daily chart of the S&P 500. The stock market is actually oversold on a short-term basis. Its daily stochastics are now below 20, which is a momentum indicator which says it's oversold. The S&P has already given up 1/3 of the gains on the October rally, which typically is a support retracement level. And then you got the 50% retracement level, which is actually now around 1992. I really doubt that the stock market is going to fall below that level this week because we've already seen it pull back sharply over the past 2 weeks, and it's oversold. In fact, the market now also has support at its 50-day moving average at 2007. Now these are in fact short-term support levels, but they all suggest to me that a bounce is going to start this week between the 1992 level and 2007 on the S&P 500. A bounce can in fact start Monday, but if not Monday, then Tuesday. Whatever the case. The key is though that such a bounce would easily carry over into next week, because next week is Thanksgiving and the market almost always goes up in the days leading into that holiday. The thing is though, if the market does bounce like this, I think it will once again though, we're going to see people start to say, we're going up forever, this is it, buy, 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 just like they did in October and just like they did in July at the two last tops in the market. And the market then fell. So what we need to do is be one step ahead of things and ask ourselves what is really going to happen over the next couple weeks and the next couple months. But let's assume that the stock market does start to go up again very soon, this week. If it does, how high will it go? Will it make a new high? Will the bulls be right, or will it just stall out again and fall hard in December? Because if it's going to do that, then you must be prepared now to take advantage of a market bounce to make changes in your account ahead of what would end up being a big decline, something like we saw in August. The key to answering that question is to figure out whether we're still in a bull market or if this is in fact a bear market. Now, this isn't hard to do if you understand stage analysis. You see, all markets go through bull and bear markets. In bull markets, the 200-day moving average goes up and acts as a price support level, a great buy point when the market falls back down to it. But in bear markets, the opposite happens. The 200-day moving average curls down and acts as a key resistance level that makes for great times to actually sell stocks after rallies. So you can tell if a market is in a bull or a bear market by what this moving average is doing and how the market is acting towards it. So take a look at this chart and you can see what I mean. The 200-day moving average on this chart is in blue. This is the S&P 500 going back to 1996. In the last two bear markets, you can see how the market actually did trade below this 200-day moving average, and the 200-day moving average was turning down. Then in 2009, that 200-day moving average acted as a price support level. The thing is, though, in those last two bear markets, there are several big bear market rallies up to the 200-day moving average, after which it would stall out and fall again. This year, the 200-day moving average acted as support until the market fell through it in August. But in October, it rallied back above it, even though at the moment it is still below it. Now, bulls say that the market fell below the 200-day moving average in 2011 and then went above it a few months later. So they claim that the drop below it in August doesn't really matter, and we're repeating what happened in 2011. They say that all we have seen is a correction in a bull market. They say that we had a double bottom and that this double bottom is real. Are they right? I don't think they're right at all. And the reason why is because of what's been going on inside the stock market averages with sectors in the market and stocks themselves. So you have to actually look beyond the averages at moments like this to really know for sure what's happening. Let me explain what I mean. In a bull market, when the market has a correction, and they typically happen at least once a year, what you'll see is sectors and individual stocks in groups that tend to hold up while the stock market drops. They don't fall as much as the market averages do. Then when the market averages bottom out, these sectors then just take off and go up rapidly to new highs and then beyond. They become the new leadership that helps drive the market in a sustainable way into a big rally. So let me show you an example of this. Okay, this is BBH. It's an ETF that tracks the biotech sector. Last year, there was a drop in the stock market in October of roughly 10%. During that drop, the biotech sector held up, and after the market bottomed, it instantly went up to a new high. You can see that in the chart. Fast. The gains were incredible, and it continued higher and higher up until the summer. Restaurant stocks did the same thing, and so did a few other sectors. Biotech and these sectors helped propel the market averages up into the middle of this year. The thing is, though, nothing like this happened on this last stock market drop in this last rally of October. Instead, almost everything got smashed very hard and fell with the averages, or even worse than the averages did during August and the beginning of September. And then when October came and the market averages went back up, they didn't rally up as much. What did go up was about a dozen big cap stocks like Nike, Microsoft, Google, and Facebook. But it was just a couple stocks. And that means that the strength in the market was so narrow and so small that I was not able to power an entire sector up with it, or an entire group of stocks related to another at new highs. In fact, most stocks, despite the rally, are still trading like they're in big trouble. Look at this. This is a chart showing you the number of stocks trading in the stock market that are below their 200-day moving averages. It's a percentage. You can see that this indicator plunged in August and then bounced in October back up to about 40% when the stock market went up. But it wasn't able to go back up to where it was just a few months ago, or even above the 50% mark. So the vast majority of stocks are unable to rally then back above their 200-day moving averages in October, even though the market averages did. Now, this is not what happens when you have a rally in a bull market, but this is what happens during bear market rallies. But the situation is actually worse than even this indicator is showing you. Okay, if you watch CNBC a lot, I'm sure you've heard people on there that work on Wall Street claim that a bear market comes when something falls 20% or more. They say a 10% drop as a correction and a 20% drop as a bear market. Well, there are over 5,400 individual stocks that trade on one of the U.S. stock exchanges. 373 of these stocks are at least 20% off of their 52-week high. So about 56% of all the individual stocks that trade in the United States are already in what CNBC calls a bear market, even with the market rally of October. And they're never going to tell you that. And you probably didn't know it until right now because they ain't told you. You see, if all you do is look at the market averages, and that's all you look at, then it is hard to know for sure what is really happening at moments like this in the stock market, especially if the market bounces this week, because that's going to make people get all excited again, but they don't know about the rot going on inside the market as a whole. And the truth is, the last time I saw stocks trading and acting this bad and this poorly when compared with the market averages was way back in October 2007, right when the last bear market just got started. I would not be seeing this, and you would not be seeing this if this was a real bull market rally. But yes, I do think that the market is going to bounce this week. However, what you have to understand now is that a market bounce is not going to be the start of this massive run, and the move that we saw in October is a mere bear market rally. We know that now because of the characteristics of the internals of the market and what's happened inside the stock market on that October move. Okay, think about it. In bear markets, what you see is occasional big bear market rallies that take the market up to the 200-day moving average. We saw this in gold too over the past couple years, and commodities. It also happened in oil stocks, in the price of oil itself. But what tends to happen then is that moving average doesn't just instantly cause the market to reverse and just go into a downward spiral, but instead a market will trade up to the moving average in a bear market and then float around it for a couple weeks. It may dip down and come back up or stuff like that. And then it takes another big leg down, but you get this sideways floating up and down basically around the moving average. I think that's what we're really seeing begin in the stock market at the start of this month, and now we're probably going to bounce back up to the moving average and then decline in a big way, or start to decline after Thanksgiving. Let me show you another example of this. This is the XLE ETF that tracks energy stocks. You can see how it hit the 200-day moving average 3 times in the past 14 months and fell every single time. People got excited though on each of these rallies, just as they're excited about the stock market right now. Now, when it comes to the stock market, it looks like we are in the kind of situation where this XLE ETF was back in this past April. You see, it rallied big in April from 72 all the way up to 82. It's a nice, huge percentage move, over 10%. And then it went sideways for about a month into the start of May, and then it peaked out and began to decline. It was a slow decline. It wasn't an instant crash, but it got worse and worse as every week went by. I kind of think this is basically what we're going to see in the financial markets going forward after Thanksgiving. So, I'll repeat, because it's so critical. If the market does bounce this week, and I expect it will, I'd interpret that bounce as a move within an overall sideways topping pattern that's going to end or play out by the end of this month, and then we'll be looking at the market start another decline. Now, this is not something to be scared of at all. You see, what is scary is when you're in the financial markets and you don't know what's going on, you don't understand what's going on. Because when you do understand, then you know what to do. You can create a game plan to adapt and to adjust to the overall market environment. And even in 2008, when the stock market crashed, there were people short ahead of that crash. I was actually one of them that made a lot of money. Now, I didn't make $1 billion like the characters in the book, what is it called? The Big Short did, I think, the Michael Lewis book. But I was fairly happy with the return I made and so forth. And here's the thing, though. In these type of markets, there's so many tools we can use to profit from what's going on and adjust and adapt. So if you're someone, for instance, that likes to play individual stocks, there's opportunities now to take selective bets against the weakest and worst stocks in the market, because these are stocks that when the market pulls back, they didn't get smashed. So if we get the bounce, I think we will, this week and next week will be an opportunity to enter bad stocks, either short sell them or purchase puts on them in the options market. And if you're an investor, you can also use exchange traded funds that are designed to go up in value when the financial markets drop. And if you're even a traditional investor, and I'm actually fit all three of these categories, I've got portions of my money slotted to each one of them. But if you also have, let's say, a retirement account and you're too fully invested now in the stock market, then really I think the prudent thing to do is to fix that, to reduce that exposure to the stock market and move into some exchange traded funds that will help diversify you into other asset classes and even other markets. So there's all sorts of things to go on. The key is that right now is the moment to prepare for the next couple weeks in the stock market. And to help you do that, I have put together the total portfolio package. We are now in what I believe will prove to be one of the most important times we will ever experience in the financial markets, because of these money shifts that are just starting to take place. In order to survive and thrive for the price of just $1 plus shipping and handling of $8.97, I will send you in the mail my 3 main books. With these books, you'll be able to separate yourself from the masses of traders now confused about what's happening in the markets, and be able to read and understand the big trends of the markets and how they change for yourself. I'm also going to include with the total portfolio package a free 30-day trial to my Power Investor group. With this, you will know what ETFs I've in my own model investment portfolio and when I buy and sell them. Every week, you also get my top trading ideas, and you'll find out about which stocks I think are the best ones to buy and which stocks I think are the best ones to bet against. And as another free bonus, I'll give you immediate access to my Bear Market Power Pack. This is an online video course I put together a few months ago to help you prepare for the next bear market and actually profit from it when it comes, and now it's here. So now, scroll down below this video to read all the details of this offer and what's inside of these bonuses. And I think you'll see that for a combined price of just $9.97, that this is an incredible bargain. This is a special offering I'm doing for you right now because I think you need to get this material before the changes we see that have just been starting to happen really impact the market averages and investment funds in an even bigger way than we've already seen. The changes in the market are only beginning. With the knowledge in this total portfolio package, you'll be able to adapt, adjust, and I believe even profit from the big trend changes that are now just beginning. Instead of doing things that are not working anymore like everyone else is doing, you would move into things that are working. So go below this video and hit the buy button, and I'll see you on the other side.